The truth is, if you zoom out and look at the 1-year chart, Bitcoin is like up 99%.
Hmm.
It's like nearly double. So if you walked in up to anybody in the street and said, hey, I'm heavily invested in an asset that is growing up 100% a year, should I be happy or not? They would say, you should be happy, right? It's just that the way that it gets there tends to be a bit volatile.
Momentum stories always feel shaky in the moment, then obvious in hindsight. Today's narrative builds on the idea that short-term chop can hide a longer structural climb. If Saylor sounds more optimistic, it is because he sees a machine maturing rather than a fad fading. What follows is how he explains the consolidation, the participants on both sides of the trade, and the reason he thinks the ceiling many imagine is too low for what Bitcoin can become.
As for why, I think the why Bitcoin has been consolidating and building its support in the teens right now is because you've got $2.3 trillion of Bitcoin that is unbanked. And so you've got a lot of people that own a lot of Bitcoin, but they can't get a loan against it. And because they can't get a loan against it, the only, at the point that you all of a sudden find yourself Bitcoin rich, but fiat poor, you don't have a lot of dollars, but you have a lot of Bitcoin and you can't borrow against it, then you think, I have to go sell it.
When liquidity pipes are missing, even true believers become forced sellers. That pressure creates the illusion of waning conviction when the real issue is credit infrastructure catching up to ownership realities. Saylor frames the present not as failure, but as a financing gap that the market will close. With those pipes in place, the argument goes, selling pressure fades, and long-term holders become more dominant.
So I think Bitcoin's right now, it's like this Mag 7 startup where all of a sudden all the employees got insanely rich on penny stock options, but they can't borrow against them, so they have to sell them. And so they're selling, and then people are saying, well, why are those employees selling the stock? Is that a vote of not confidence in the company? And the answer is no. It's just they have kids to go to college. They want to buy a house, right? They want to live comfortably. They want to do something for their parents.
The startup metaphor reframes supply as life cycle rotation. Early employees cash out a slice for real-world needs while the enterprise matures. In that lens, distribution is a feature, not a flaw, because it sets the stage for deeper, steadier ownership. The center of gravity shifts from early adopters to institutions that require calmer seas.
And so right now, I think that the selling is crypto OGs that have had a lot of money for a long time. They're selling 5%, diversifying. They're doing something like that. And the market is absorbing all of that energy, building its support. The volatility is coming out of the asset. That's a really good sign. But because what you want for the asset to mature is for lots of long-term capital holders, the big corporations, the big institutions to buy.
If the end game is an institutional float, the transition demands patience. Volatility dampens, headlines quiet down, and the narrative cools just as the groundwork for larger allocations is laid. Boredom in this phase is not a bug. It is the cost of admission for serious capital that prizes stability over spectacle.
You want the volatility to decrease so the mega institutions feel comfortable entering the space and size. And the conundrum is, well, if the mega institutions are going to enter, if the volatility decreases, it's going to be boring for a while. And because it's boring for a while, people's adrenaline rush is going to drop. And it's like they had this big high and now the adrenaline is wearing off and they're a little bit bearish. But this is just a growing stage or, natural for the life cycle of an asset that's monetizing like this.
Here, Saylor draws a clean line between entertainment and monetization. Price fireworks capture attention, But balance sheet adoption requires dull confidence. If his forecast expands, it is because he believes the buyer base will change in kind, from thrill seekers to treasurers. That swap can quietly reprice the entire asset without the dopamine spikes that retail expects.
Yeah, I think there are a lot of assets, property, the greatest property assets of Western civilization, assets like diamonds, assets like gold, assets like old masters' paintings, assets like land, uh, the Louisiana Territory, California, Mexico, all of Alaska. None of them have cash flows, right? All of the great things we've acquired in life.
Value in his framing is not confined to coupons and dividends. Monetary assets are prized for properties that transcend yield, and history is full of examples. If Bitcoin graduates into that family, the valuation lens widens beyond discounted cash flow. That is the pivot where price ceilings begin to look like floors.
And of course, as we know, the perfect money has no cash flows. The whole definition of money, a liquid, the most saleable asset. But if you want something to be money, you want it to have no utility value. Gold is better than silver because it has less utility value. And when copper, or when you find something like silicon that has utility value of some sort, it becomes worse money.
Scarcity and neutrality are the selling points in his monetary theory. By pushing Bitcoin into that category, the conversation shifts from earnings to entropy resistance. The more it resists being useful, the more it excels at storing value. That paradox undergirds a higher terminal value than typical equity analogies imply.
Eventually, the S&P 500 became the monster. If you look at index investors, 85% of indexes are invested in the S&P. So many people think long-term capital, what they think of as money held for the long term, is an equity index like the S&P index. Vanguard, they commercialized this and they made famous the idea of the Vanguard 500 and the Vanguard Index Fund.
Entrenched models do not surrender easily. Index orthodoxy solved a 20th century problem and became a habit. If Bitcoin is the upgrade, it must dethrone a deeply familiar default. That friction explains slow adoption and helps justify why, if adoption happens, the repricing could be abrupt.
If all of the boundary conditions are set, and if this, 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 then you can just plug in this number and you'll get out that answer. And that is true as long as you don't change any of the boundary conditions of the assumption. If you've got the solution for aluminum, and then I change change the metal to steel, then the formula doesn't work. Mm-hmm. So at that point, you can't use a particular solution. You have to use the homogeneous solution. You have to be not the engineer, but you have to be the physicist. You can't be the trade craftsman with the simple lookup table of the answer. You actually have to derive it from first principles.
Saylor's escalation in outlook stems from a claim that the boundary conditions have changed. In a world of rolling currency crises, digitized treasuries, and global settlement in seconds, the lookup tables of the past fail. If allocators rederive from first principles, they arrive at a different store of value mix. That is the hidden lever behind a bigger number.
I can give you not in a Russian currency, before the collapse of the ruble that took place at the turn of the century, 96 or something. So the people that have these ideas, they have a particular set of solutions that work in a very stable, closed ecosystem that's never been challenged either with external stress or never encountered a new idea.
Stress tests change minds faster than white papers. When cash flows vanish in a broken currency, the spreadsheet logic collapses, and monetary logic takes over. Bitcoin's pitch grows stronger, where trust in units grows weaker. That asymmetry is why adoption can swell from the edges toward the center.
So I think, the great irony is, again, the CEO of Vanguard saying Bitcoin is not an investable asset because it doesn't have cash flows, and then the largest shareholder of my company being Vanguard.
Ironic.
The most ironic outcome is most likely, according to Mr. Musk.
We traced Saylor's framework from market mood to monetary theory, from forced selling to institutional boredom, from index habit to first principles revaluation. His case for a much higher future rests on structure, not sentiment, and on the idea that when the boundary conditions shift, the answers must be recalculated. One last word from him as we step back and let the thesis sit on its own.
When the people that will get Bitcoin will either come out of very chaotic environments, collapsing currency environments where they had to think for themselves, or they'll be at their base kind of scientists, first principles thinkers, people that question everything and rederive it.
Where do you fall on that spectrum today? And what boundary conditions in your world would have to change for your answer to change with them?